Rolling over your old 401k from your previous employer sounds simple, but it's one of those decisions that can hurt you in the long run if you're not careful. This is episode 22 of SWBC's Uncharted Wealth podcast. What to know before you roll over your 401k. Hello and welcome to SWBC's Uncharted Wealth podcast, where I help you explore the financial landscape and navigate your journey to and through retirement with confidence and clarity. I'm Mike Walters. I am a wealth advisor and a certified financial planner here at SWBC, and today we will be talking about rolling over your 401k. Okay. There's some things that you need to know before you do any type of 401k rollover. We'll talk about timing, tax traps, Roth conversions, and why sometimes it's actually better for you to keep your 401k where it's at. So let's jump in. Now, there is something that I call the rollover reflex, and it's basically everybody has this kind of reflex built into when you leave your employer, you're just automatically going to roll that 401k over, either into your new employer or into maybe a separately managed like traditional IRA. It's just kind of a habit, okay? It's clean, it's simple, it feels like the right thing to do. However, there's a problem. That simplicity isn't always the best strategy, okay? Rolling over can do a couple different things, okay? It can limit your access to early withdrawals. It can trigger some unnecessary taxes if you don't do it right. It can disrupt Roth conversions if that's a strategy that you are utilizing. And it can remove access to institutional investment options. Again, this just depending on how your 401k is structured. But the main thing here is there is something called the Rule of 55 or the age 55 exception. And what that means is that if you leave your job at age 55 or later, you can take penalty-free withdrawals from that 401k as if you were 59 and a half, right? Because 59 and a half is the rule for IRAs. But again, if you leave your employer and you leave your 401k with your employer, you can actually take distributions from that 401k a few years earlier without that early withdrawal penalty. So if you roll it over too soon, you lose that capability. So this is a big deal for any type of retirees that are looking to retire before age 59 and a half, okay? Or if you're doing a phased retirement and you need to draw income from your 401k for a few years until you have, other options turned on, such as Social Security or pension or what have you. So keeping the 401k where it's at that time just might be the smarter move. I mentioned it earlier that there may be some tax traps when doing a rollover, and they can go wrong pretty fast. So here's what I'm talking about. If you do what's called an indirect rollover, okay, this is where you actually take possession of your 401k funds. So for example, let's say that your 401k is with Fidelity or Vanguard or one of these big custodians, and you are trying to roll it over to your individual retirement account, let's say at Schwab. Okay, there's an option that you can choose called an indirect rollover where Vanguard or Fidelity will actually send you a check, okay, for that 401k amount. And it's on you to send that check then to your custodian, like Schwab, in order for it to get deposited. But you have to do it within 60 days. If you miss that window, that entire 401k rollover is not a rollover anymore. It is a taxable distribution, okay? So you'll be taxed on that entire amount because you missed that 60-day window. You can also only do one indirect rollover per year across all of your IRAs. So if you have multiple, orphan 401ks out there and you're trying to consolidate them, just know that you can only do one indirect rollover per year. The other ones would be considered distributions. Also to note, if you have any type of 401k loan that is currently active on your 401k, you need to make sure that when you do a rollover, a lot of times 401k plans, if you have a loan with outstanding on it and you try to attempt a rollover, they are going to consider that outstanding amount a taxable distribution. So, for example, if you have $50,000 in your 401k, you currently owe $5,000 back to a 401k loan, and you try to roll over that 50K, they are going to tax you on the 5K just as if you took a distribution. So not only do you pay ordinary income tax on it, but if you're under age 59 and a half, you're going to get hit with a 10% premature distribution penalty as well. So it's important that if you're going to do a rollover, make sure you do a direct rollover, okay? Know the rules around that. And then also, if you are planning to do a rollover to a Roth IRA, just know that, hey, this is considered a Roth conversion, and you will be taxed on the entire amount that you roll over from a pre-tax 401k to a Roth IRA or a Roth 401k. Now, there are a few times where you probably don't want to roll over your 401k, and here's a few of those options. So, number one, if you are going to be retiring at age 55 and you want penalty-free access to those funds, it's best to leave it at your 401k. If you're still working and you have access to a solid 401k plan with your new employer, then it might be best to roll your old 401k into your new 401k. Okay, so you can access those better options. Another option here is if you are implementing a backdoor Roth strategy. So this is a more advanced strategy that we do with some of our high income clients, to where if you are doing a backdoor Roth contribution, which means you are making non-deductible IRA contributions each year and then immediately converting to Roth, you cannot do that if you have money in a traditional IRA. Well, you can do it, but you're going to be messing with something called pro rata rules, to where at the end of the day, you're going to end up paying more taxes than I think you're originally wanting to. So you just have to be careful of that. If you're implementing backdoor Roth strategies, you don't want to have any money in traditional pre-tax IRAs. And just to harp on that point, if you are planning Roth conversions and you want to control timing to obviously avoid higher tax brackets or any of these IRMA surcharges, you're definitely going to want to hold off on rolling over your 401k to an IRA or taking distributions from it because of that. Before I go any further, if you have not subscribed to this podcast, then please do so now. I'll give you a couple moments. We appreciate that. Go ahead and like and comment on these videos if you find this stuff helpful. And if you would like to get more information or maybe speak with myself or another advisor on the things that we talk about, there will be a website in the description to where you can go ahead and schedule that phone call. Moving on. Now, this brings us to the uncharted territory for today's episode. This episode, we are going to be talking about a hidden opportunity in your 401k if you have employer stock. Okay, this is called the NUA strategy. It stands for Net Unrealized Appreciation. If your 401k contains company stock, you have access to this powerful but often overlooked tax strategy called NUA, and it allows you to transfer that company stock out of the 401k into a brokerage account, and then you roll the rest of your 401k into an IRA. Now, what does this do? Okay, you're going to pay ordinary income taxes on the cost basis of your stock. What does that mean? It means if you have company stock in your 401k, and let's say it's worth $100,000, but you only paid $40,000 to purchase that stock, that means when you roll that using an NUA transfer, you're going to pay ordinary income tax only on that $40,000 that you paid for the stock. The $100,000 is just the value of it as it rolls over. Now, the growth, the NUA portion of that rollover, okay, so in our example, that extra $60,000 that you did not pay taxes on in the rollover, that will then get taxed as long-term capital gains when you do eventually sell the stock, okay? Long-term capital gains tax rates are often much lower than your ordinary income tax rates. So, for example, if you're in a 22% marginal tax rate and now you have the opportunity to sell stock at a 15% capital gains tax rate, this is how you can kind of save some taxes over the long run if you plan to hold onto that stock in the long term. Okay, this can result in significant long-term tax savings, especially if the stock has appreciated substantially. Okay, now important caveats to this strategy is it has to be a lump sum distribution after a triggering event. That means you either retire or you leave your employer, like separation of service is what they call it. And the entire 401k has to be distributed within the same calendar year. So you can't just do the NUA transfer in 1 year and then roll over the rest of it in the next year. It all has to be done in the same calendar year. So you're definitely going to want to coordinate this with your financial advisor or your tax professional. Now, the key takeaway for today's episode is that rolling over your 401k can be smart, okay? Especially if you're trying to consolidate all your assets and preparing for a more simple retirement plan. But rolling over is only going to be smart if you're doing it with intention. Don't let that retirement reflex, that old habit, drive your decision, okay? Let the strategy lead, okay? I'll encourage all my listeners to do a few things here. Review your age, your retirement timeline, and your withdrawal needs before submitting any 401k rollovers. If you have any company stock in there, review or speak with an advisor to see if an NUA transfer would be in your best interest long term. Also, if you are planning to retire at age 55, please understand the rules before making a move. And then last, talk to an advisor, especially if you are expecting any type of tax implications for your rollover. See how that's going to affect your retirement strategy and your tax considerations. So if you are considering a 401k rollover and you want to make sure it's the right move for you, let's talk. Again, visit the webpage in the description and you can schedule a free consultation with myself or another advisor here at SWBC. Thank you everyone for listening to the 22nd episode of the Uncharted Wealth podcast. As a reminder, nothing talked about today is to be construed as financial advice, legal advice, or tax advice, and then all the opinions shared are mine and mine alone, not SWBC or its executives. So again, if you haven't subscribed, please go ahead and do so now. Like, comment, and share this with your auntie, your mother, your grandpa, and your cousins, maybe even your best friend. And we'll see you on the next episode of Uncharted Wealth. Peace! Hello, and welcome to SWBC's... You don't like the hello? Hello! We're going to keep that energy so up today. It sounds simple.
Investing involves certain risks, including possible loss of principal. You should understand and carefully consider a strategy's objectives, risks, fees, and expenses, and other information before investing. The views expressed in this commentary are subject to change and are not intended to be a recommendation or investment advice. Such views do not take into account the individual financial circumstances or objectives of any other investor that receives them. This information should not be considered a solicitation nor a recommendation of an offer to provide any service in any jurisdiction where it would be unlawful to do so under the laws of that jurisdiction. Past performance is no guarantee of future results. Please consult with your individual tax professionals and/or attorney for additional information.